All right. Well, good afternoon, everyone. This is Scott Thompson, and we are here for our Stock Investing for Beginners webcast. This is lesson number 7, How Much to Buy. And one of the huge takeaways today, hopefully for you, is if you've ever suffered from analysis paralysis or just have not been able to kind of pull the trigger and take action, hopefully some of the things we talk about today will help overcome that. Great to be here with you today. Give a shout out to Janelle and Jay Richardson and Gary and Eva and Rojo and Will and everybody else that's here, Gary, Jody. Thanks for taking time out of your schedule to be here. Ben Watson's in the chat there. If you have some questions, he can take care of those for you. I will also review those, and then usually I'll repost those questions in the YouTube comments when the archive is posted. So you can review those there as well. Um, but again, great to be here with you. Before we start, as always, remind everybody our presentation today is for educational purposes only, not a recommendation or endorsement of any particular investment or investment strategy. Um, the paper money account that we use for our sample trades is going to be, different than the real money account in Thinkorswim. We talk about stop orders all the time. There's no guarantee that execution of a stop order will be at or near the stop price. Be aware that all investing involves risk, including the loss of principal, and past performance is no guarantee of future results. Um, as you know, we've been going through our lessons series. We have 8 lessons, and last week we did lesson 6, and today we're doing lesson 7, how much to buy. We'll talk about position sizing and allocation. Our agenda today is to go through some definitions, look at the position sizing formula, look at the allocation formula, talk about investor psychology a little bit. We did that in lesson 3, but revisit that and talk about some ways to overcome some of the challenges that we run into as self-directed investors. And then we'll hopefully put on a couple sample trades today as well. So again, welcome to everybody that's joined us. Let's jump right in here. Position sizing versus allocation. Now, these are sometimes used interchangeably, but I have 2 definitions that I want to share with you. Position sizing is determining how many shares to purchase based on the amount the trader is willing to lose on the trade. And what's called the risk per share, which is the difference between your entry price and that stop order price. And you as a trader or investor will have to determine a dollar amount that you're comfortable losing. I've talked to people in the past and they say, well, I don't want to lose anything. Well, nobody wants to lose money, but the reality is that some trades or some investments aren't going to work. The company could get bad news, the company could go out of business, the trends can change. All of these things can contribute to having a loss. Even if you're just doing a buy and hold forever type of scenario, if you buy a company that goes out of business, you're going to lose money on that particular investment. So, one of the things that we'll talk a little bit more in a minute is this idea of accepting that a trade could be a losing trade. And as simple as that sounds, or as maybe elementary as that sounds, man, that was a hard thing for me to accept. And I'll talk more about that in a minute. Now, allocation is determining how many shares to purchase based on a percentage value of your whole portfolio. This one's, pretty intuitive. If you invested 10% of your portfolio in a stock position, then you could have up to 10 positions. If you invest up to 5% of your portfolio in any single stock position, then of course you could have 20 open positions. And so when you're talking about allocation, you also want to think in terms of, well, how can I manage, 5, 10, 15, or 20 open positions? And, we actually have a really simple method with our sample investing plan that we call our 2 green arrow investing plan. It's really quite simple to manage, multiple positions because there's just one thing we're looking for, which we'll talk a little bit about because we've been stopped out of a couple positions here as of late. But those are position sizing and allocation. Um, I have a few dialogues that I want to go through with you today. These are maybe a little bit simplistic, but the idea here is just these are some of the thoughts and things that went through my mind when I first started trying to invest and trade. And of course, one of them is how do I position size a trade? And then here's the formula. The number of shares that we're able to purchase is we take whatever our acceptable loss amount is, and divide that by what we call the risk per share, or the difference between your entry price and stop price. And we'll look at some examples later in this presentation, but that's one formula that I think you want to remember or at least write down. If you're doing an allocation model, that's a little different formula, but this one, the purchase is just simply based on the percent of our account we're going to invest divided by the price per share. So those are fairly simple formulas that you can use to help you determine the number of shares to buy. Back when I first started trading and investing, I thought you had to buy 100 shares of stock. And if you didn't, they actually called that an odd lot, and they charged you a bunch more commission for those sort of things if you've been around the markets for a little while. And nowadays, we don't have to buy 100 shares. You don't even have to buy a full share. There's different ways to do investing now that it was not available way back in the day. So anyway, those are a couple formulas that I think are important to learn. Let's revisit this investor psychology a little bit. We covered this in lesson 3. And part of this idea with investor psychology is learning to control risk. It's important to control how we or you psychologically and emotionally deal with losses. It's very common for us to let our losers run, meaning that the loss gets worse and worse and worse and worse. And usually what happens is we let that happen until we just cannot stand another dollar, another $100 of loss. And then we close that trade down after what has become a horrible, devastating type of loss. And oftentimes, many times, that's at the bottom, right? Where the market finally reverses and goes back up, but now we're not in there anymore. So, we want to try to get out in front of these ideas with the emotions and psychology behind investing. The other thing, that third bullet that I think is really, really important, if you get nothing else out of our lesson today, losses will occur. It's part of the cost of investing. It's part of the experience in investing. Even a buy and hold trader, if they happen to buy a stock that, has horrible news or just really doesn't ever perform well, that stock could go out of business and you have a loss. So I think accepting that is a huge part of being able to trade and invest successfully. All right. Let's take a look here. Another little dialogue. And this one, I don't know if you've gone through this, but hopefully it's maybe triggers some memories, maybe, or maybe you're dealing with this right now. And so, if I'm talking to you, hey, did you see that bounce on that tech stock you've been watching? Yes, it's up over 2% today. Fantastic, great job on a big payday for you or whatever. Well, I didn't buy it. I was too afraid to pull the trigger. Do you know anybody that's run into that scenario before, where maybe you've been watching a stock for multiple days and you're just either waiting for it to give what you feel is that really solid buy signal, or it's waiting to bounce off support or a moving average, or it's waiting to break resistance, and you actually see that happen, but you don't take action. And so this was like one of the things that was so frustrating today, or not today, but just, when I first started, was, being able to take action. So we're going to talk about that today. So analysis paralysis, this is just, kind of a quote that it's put together from many investors or traders. I'm so frustrated. I can see the buy signals, whether it's a green arrow, that hold, bounce off support, or a break resistance. I can read the charts so they can see the trend. They can see ups, higher highs and higher lows, but they just cannot get themselves, or can't get myself to pull the trigger and make a purchase. And so I do have some ways that can fix that. I've broken it down into 3 different things that I think really help with this. There's probably some others, but there's 3 that I want to concentrate on today. All right. So let me run through a little bit of a dialogue that I found to be kind of common when working with new investors, new traders. So, and again, hopefully this resonates with you, or maybe you know somebody that's kind of gone through this. And if not, then hopefully when you run into somebody that deals with some of these ideas and questions and challenges, you'll be able to help them. So, we're back to that person that saw, that tech stock they've been watching, but they didn't take action. And I said, why didn't you pull the trigger? Well, it was a more expensive stock and I didn't feel comfortable buying 100 shares. My response, I didn't, this wasn't the case when I first started, but this 21st century, you don't have to buy 100 shares anymore. Wait, what? And some of these things are just like that. You just assume a few things and you don't even try to buy 1 share or 10 shares or 3 shares. But hopefully you've seen me and Ben and Cameron and the other coaches in our webcast placing orders for different numbers of shares. As few as 1 share or even less, on up to 42 shares or 118 shares. Based on a risk tolerance idea. And I said, well, were there some other reasons you didn't pull the trigger? So let me have you here um, type in, what were some of the reasons that you ran into that made it challenging for you to take action? I'm very curious to see what some of those things are or were in the past or perhaps are you're dealing with right now. And so, as you type those in, really appreciate that to see. But what are the other reasons you didn't pull the trigger? Well, I saw the bounce, that hold thing, that close above the high of the low day, but I wanted some more confirmation. This was me. Okay, when I first started, I did learn that bounce buy signal, and I could see the stock, make a high in the trend, pull back a little bit, and get down near where it looked like there was an old resistance level that might become new support, or get near a moving average and think, oh, there's it looks like it's near support. This might bounce. And so, and then I would see it close above the high of the low day, and it would be just by a little bit, like, 30 cents or maybe $1 or whatever. And then I would think, oh, let's get a little more confirmation. And then the next day it's up another 12 or 15 or 18 cents or whatever. And then I'm like, I'd just really like to see a lot of more confirmation. And inevitably, and maybe you've dealt with this, but inevitably that third day, the thing would take off like a rocket, be up 2% or 3% that day. And I feel like, oh, I can't buy it now. I've missed the trade. And so, that's one of the things that I ran into, and maybe you've run into that as well. Scott says, not being able to pull the trigger, the price is approaching another resistance level. Overall markets are bearish or, not in line maybe with what you're trying to accomplish. Unsure about the fundamentals and management company. Those are great ideas. Jay Richardson, too much on my screen. That one's really common. I like to joke that if you draw enough lines on your chart, one of them will be right. But there's a lot of reasons that we don't take action and don't pull the trigger. So I want to hopefully address some of those and help you through that. Um, and so, my question here is, well, why did you want more confirmation? And again, this was so much me when I first started, is I didn't want to be wrong. And my definition of wrong was incorrect. My definition of wrong is if I lost money, I was wrong. Now, that may make sense, but it's not correct. You and I can do all the analysis that we require. We can identify a stock that has strong fundamentals. We can identify a stock that's uptrending if that's part of our buy signal, like our two green arrow plan is. And it can still go against us. And because I didn't want to be wrong and I didn't want to lose money, I would often not take action. And so maybe that's common for you as well. Now, let's dive in a little deeper in here. You mentioned being wrong. What do you mean? Well, with the entry signal, I wasn't sure if I should buy it now or wait. I don't know how many times in the last year that I've been teaching this stock investing for beginners webcast, how often that's come up. Should I buy now or should I wait? I can see the two green arrows. I've had people, I think even just last week, well, I don't want to buy when it's at the high. And they've done some interesting studies on buying at all-time highs versus buying at, what people consider lows. And so there's some interesting things. I think I did an internet search, and I think the most brand new all-time highs that we had in one year, and I don't remember what year it was, but it was in the 2000 20s, I believe, was 77. So throughout the course of the year, where there's about 252 trading days, there were 77 new all-time highs in that year. And so, it's important to understand that, you know, there isn't a holy grail, um, entry signal. So the question here, so if you had an idea, but not your take action trigger, you hadn't defined exactly what that buy signal is, right? I guess I just don't have my own entry signal. So again, for homework today, if you will, decide for sure, exactly what's going to be your entry trigger. And then what I'd like you to do is to paper trade that entry trigger 10 times in your paper money in a row, and try to be perfectly on target with that entry signal. If it's a green arrow that's, valid with 2 days, or 2 days of a green arrow, or if it's a literal close above the high of the low day and you're going to buy 30 minutes before the close, or you come home from work and the market's closed already and you've seen that there's a bounce or a breakout or a green arrow of sorts, and you're going to place a limit order at the closing price for the next day. Whatever that buy signal is, for homework, I would love to have you do 10 of exactly the same entry signal in a row in your paper money, so that you can go back then and analyze how that's felt for you. Okay. Now, another thing to consider, you talked about losing money, or you mentioned losing money. You realize all trades can lose money, right? And as elementary as that question sounds, I didn't accept this. I just didn't. I was this guy. Really? Even the ones with a perfect entry signal? I learned my initial entry signal that I learned was very similar to that two green arrow entry signal that I've been teaching over the last year with our two green arrow plan. And it was a while, I want to say maybe a year or more before I really accepted this. You know, there's just no perfect entry signal. There just isn't. And once I accepted that, it made my trading a lot easier, because I think there are a lot of good entry signals, but there's no perfect one. There's no never lose entry signal. Okay. And so hopefully this little dialogue either brings up some memories. Now let's fix it. All right. Overcoming analysis paralysis, the fixes. Now, these are three considerations here. Like I said, it's not necessarily a comprehensive list, but I think these are helpful. All right. The very first thing is accepting that there's no perfect buy signal and that every trade can be a loser. Again, that sounds really unusual, but accepting that versus fighting it all the time really makes your investing life easier. Number two, if a loss always is possible, then we got to get a way around how, to determine what loss is acceptable, right? That was another really hard thing for me when I first started, is that once I accepted, okay, this trade could be a losing trade. Oh, well, how much am I willing to lose? What is an acceptable loss? And so I have a way to talk about that today. Okay. Then third is asking yourself, what would have to happen for me to take action? And, this was another thing that was really fun actually to work on, because, if you think about a race, right? It's, on your mark, get ready, get set, go, right? We talk so much about the go, which is what someone might consider the buy signal, that we don't really spend a lot of time talking about what I call the setup. The setup is what the stock looks like just before you get your go signal or your action item. And so, what would have to happen? This is a great question to ask. What would have to happen for me to buy this stock? And a lot of times that's this question: what would have to happen tomorrow? Because, we're coming home from work and the market's closed or whatever. And we're trying to get ready to act before that buy signal actually takes place. Man, that was such a cool thing to learn that. So we'll talk a little bit about that today. All right. So be ready to take action. Now, here's the first, these fixes. Now, if we go back and take a look at the investor psychology part of accepting, these three bullet points are that investor psychology page now just broken out a little bit. Learn to control risk, not eliminate it. You know, like I said, every trade could be a losing trade. So we're learning to control risk, not get rid of it completely. Okay. It's important to control how we psychologically and emotionally deal with losses. And what I mean behind this is we need to be able to take that next opportunity. How many of you have been in a scenario or know someone who has where you just took what I'll call a devastating or a way bigger loss than acceptable, and you just shut down? And then you're looking at a stock that meets your buy rules. It meets everything that you like to have. If it's strong fundamentals, uptrends, breaking resistance, bouncing off support, whatever it is, you see your buy signal and you know it's your buy signal. But you are just so devastated from the last loss that you just cannot stomach putting on a trade that might be another loser. Okay. And so, all of what we're talking about today will help deal with this. Now, losses occur as part of the cost of investing. And again, this was hard for me to accept. There is no perfect never lose buy signal. There's a lot of good ones. I think the two green arrow rule that I taught and have been teaching for over a year in this class is a good buy signal. It's not perfect. We've had stocks that lost money. We'll have stocks that change trend right after we get in. There's bounces and breakouts. I think those are good. I think moving average crossovers, there's a whole bunch of them, that I think are good buy signals. What happens after we buy it, we really can't control that. What we can control though is how many shares we buy and where we decide to get out of something. All right. So let's jump in here a little bit deeper. Okay. How do you determine your acceptable loss? Not my acceptable loss, your acceptable loss. So this is just an exercise that I think is pretty easy for people to do. Consider a night out on the town. How much do you spend when you go out with your friends? You go out and shopping. What is it? $50, $100, $200? What's kind of just normal? All right. And that's probably going to be different for everybody. My son who's, working, say, part-time, probably not going to spend $500 going out to eat with his buddies, but he might spend 25 or 30, right? Someone who's been married for a little while and they go out with the family, maybe they're dropping $200, $300 for a family meal or whatever somewhere. All right. So consider that. Another way to look at it is, use that as a starting point. Some people use a car payment. Some people might look at a subscription that they have as a few examples. All right. Now, if the stock price drops and that loss occurs, would losing that amount be acceptable? So that's ultimately what you're trying to get at is, if I buy the stock today and it goes down tomorrow, down the next day, down, 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 or goes up and down, but eventually it stops me out and I have a $50, $100, $200 loss, is that okay? You're trying to determine what number that is, okay? So you have to have a starting point. Now, here's a question I think that's even more important, okay? Once you have that amount in mind, consider these two questions. Am I really, no, really, willing to lose that dollar amount on this trade? Yes, this trade, not a trade on the next one, not in the future, this one. Well, Scott, I wouldn't take this trade if it was going to be a losing trade. Okay, wrong question. This trade that you have your perfect buy signal could be a losing trade. So I want you to think about it in terms of this trade because it gets your mindset right. Okay. Am I willing to lose this $50, $100, whatever it is on this trade that I'm taking and considering right now? And then after you've got that answer, I want you to go to this next question, which I think is more important. Am I willing to lose that amount 3 or 4 times in a row? Do you know anybody? Okay. Do you know anybody that's lost more than one trade in a row or put on a couple trades and they got stopped out of 2, 3, 4 trades in a row? Well, I know somebody that has. So, when you start asking this question number 2, 3 or 4 times in a row, you might have to go back and revisit question number 1. I'm willing to lose $50 on this trade, but if I lose $50 four times in a row, that's $200. I don't know if I feel so comfortable there. Well, then go back and visit question number one and maybe make it $30 or $25 or whatever it is. All right. So those are the questions that hopefully you can help with. And, if you want to make your trading easier, now again, there's levels that we're trying to do here, but if analysis paralysis, if your inability to take action is a problem, then I would tell you to do this. Reduce your risk. Just make it as really, really low where you just literally don't care what happens. And, that might be starting off with buying one share. You buy one share of Apple, you put a stop $30 away, and it goes down $30 and stops you out, you lost $30. Yeah, okay, maybe I can handle that. So, a lot of the answers to this analysis paralysis is just risk less. All right. Again, hopefully these questions will help you kind of determine your acceptable loss, um, and you can find some place to start. Okay. If it has to be one share to start, start there. Now, the other thing that I think is important is, what will cause you to take action? If you remember back in our little dialogue that we just went through, the individuals were watching a stock, they were looking at it, they learned about a bounce or a hold, that close above the high of the low day entry signal, but they didn't really adopt it as their own. You know, my buy signal is blah, blah, blah. Jay Richardson, I want you to write down my buy signal is, and then, fill in the blank there. Eva, you've been doing this for a long time. I know that you've got one, but, Jim and Scott Luck and Lori and everybody else that's here today, I want you to write down, what is your buy signal? And so let me give you some examples. Okay. I will buy when the stock trades above the high of the low day by 20 cents. Okay. That's an example type of bounce entry signal. And guess what? Everyone's got advantages and disadvantages, right? So if the stock moves up through the high of the low day and you have what's called a buy stop order to get in, if it goes up 20 cents above the high of the low day, what's the disadvantage? Okay, everybody that's used the buy stop should learn this one because it's probably happened to you, is the stock might go up 20 cents, 25 cents, 50 cents above the high of the low day, trigger your order, and then at the end of the day, stock's back down and not only closing below your entry price, but closing below the yesterday's low, making a new low, right? So that's a disadvantage. Why in the world would anybody try to buy a stock 20 cents above the high of the low day rather than wait for the close? Well, the advantage of doing 20 cents above the high of the low day is hopefully we catch this big green or white candle that the stock bounces and it takes all that momentum, and at the end of the day we're up $1 or $2, $5 a share. So again, every entry signal is going to have advantages and disadvantages. All right. A breakout, here's an example of a breakout entry signal. I'm going to buy during the last 30 minutes of the trading day. Well, you have to be able to check the market during the last 30 minutes of the trading day if this is you. If the stock is trading above the resistance by at least 0.5%. So we're getting very specific here, and if it's trading above that by 1 penny, we don't take action. But if it's, 0.5% or 0.75% or 1% above that resistance during the last 30 minutes of the day, we're going to place an order to buy that. And so we watch it for a few days, and then bam, there's our buy signal when it closes above resistance. Now, you may not have an opportunity to do that because you're working during the last 30 minutes of the market day. And so, you have to create a buy signal or a take action signal that works for your lifestyle and your time availability. All right. Now, the other one, and this is like an indicator-based buy signal that we're actually using in our 2 green arrow buy signal, is, if it's indicator-based, buy within 2 days of the MACD turning green. That one's pretty straightforward. I'd like to see you be a little bit more specific here and actually go in and, are you going to buy at the end of the day? Get real specific on that signal. All right. And so, look for that. But for an indicator, the stock price, if the stock's above the moving average, we say that's a green arrow, and those green arrows are green until they turn red. The MACD, you can see, will give these red or green arrows depending on the momentum. And so, like on the far right side of this little graphic, we can see that the MACD turned green 2 days ago, right? And so, stocks above the rising moving average, we got a green arrow within 2 days. That could be an indicator buy signal. All right. So let's go look at some examples here. We've got some time left. Let me go into our Thinkorswim platform. And over here on the left side, I just have the different sample plans that we're doing. The focus today is going to be on this sample plan here, so we can do our allocation, we can use some position sizing and go through some examples. So I want to scroll this down a little bit. Let's just open up some space here. And let's go back. Now we're saying that we have a $10,000 account. And so if we did an allocation, 5%, oops. So how much is 5% of 10,000? Well, that's 500. So if we were going to allocate up to 5% of our portfolio to any single stock position, then we could buy up to $500 worth of that stock. All right, that's the allocation model. All right. What if we're doing that position sizing model where we're trying to decide, how much of a loss is an acceptable loss, and using our risk per share, the difference between our entry price and our stop price, as helping us determine the number of shares to buy. So I'm going to say position size here. And I determined, I guess, is we're going to risk 0.5%. So 1/2 of 1% of the portfolio. That's our position sizing acceptable loss amount. So what's 1/2 of 1% of 10,000? Does anybody know? So that's $50. If I did my math right. All right. So, these two rules will help us determine how many shares to buy. Now, I'm going to do a little review before we do this example here on target. If I chose $50 as my acceptable loss amount, what's the first question I'm supposed to ask? Okay. Am I really willing to lose $50 on this trade on target that we're doing today? The answer to that's no, then that number's too high. All right. Let me give you another little exercise here that will help you do this. Just start with something like $1. So let's see. Scott Luck and I are going to play a game here today. And then I see your question, Scott. Let me get to that in a second. I'm going to say, Scott, are you comfortable losing $1 on your next trade? And Scott's going to say, you bet. I wish all my losses were only $1. All right. And then I go, well, how about losing $10? And Scott's, yep, no problem. All day long. How about 20? Sure, no problem. How about 30? No problem. How about 50? So right there, do you see the little difference between the answer to the question? Are you willing to lose $1, $10, 20, 30? Yeah, no problem, no problem, no problem. And then when you get to a number that you start to think about it too much, or you start thinking about it a little bit, you've probably hit your threshold. All right, so back that off, go back to $30, go back to 35, where you can answer with that resounding, yeah, no problem. I can handle that loss. So we just decided for our account, it's going to be 0.5%. It doesn't have to be 0.5%, might be 1/10 of 1% when you first start off. All right. So those are the parameters within which we're working here for a target. Now what I want to do, Scott says, should there be a rule to add in terms of the state of the market and or sector that the stock is in? Should there be a rule? With our two green arrow rule, looking for stocks that are uptrending, we do make some assumptions, but I think it's very useful, Scott, to be aware of what the market trends are, whether it's long-term, intermediate term, and short term. In fact, I did a little short, a YouTube short on determining your market posture. There's like three little videos. They're all 2 minutes long. So go to the Trader Talks YouTube page, look at the shorts watch list or the list there. And I have a little video on how to determine the trend for long-term, intermediate term, and short-term trend. And we've done that in this class before. So I do think it's very useful. For the sector rotation that you ask about, is it important to know what the sectors are doing? Yes, I think it is important to know what the sectors are doing. So doing that is probably part of a weekly routine, very useful. Again, when we're looking at stocks like Target, for example, that is already uptrending and just making another new high, we may not know what sector this is in, but Target, I believe, is in the consumer staples sector. And so, if nothing else, we know Target's uptrending, but sure, it'd be useful and good to look at the sector. I haven't done that very often here lately, partly because we're going through the lessons, but also because, for time, we're really making this simple. Two green arrows. If the stock's in a uptrend and it's got the green arrows, we're going to say that's a valid buy signal. All right. So great question. Let's see. Jay Richardson, I wish I heard Scott when I was first started. Yeah, I wish I heard myself too. I just, I think I've made every mistake that an investor and trader can make, and so I really do like to share some of these experiences with all of you because I just wish somebody beat it into my head or even just knew some of this stuff. It would have made my life much easier, and I think I would have saved thousands and thousands of dollars. So anyway, let's take a look here. What I want to do on Target is I want to go through a little exercise with you uh, on Target as we kind of look at basically getting ready to buy. Okay, so what we're going to do is just go through a few days here. We're going to move the chart forward a day or so at a time, and then we're just going to ask ourselves, do I have a valid buy signal? All right. And remember how I talked about getting ready? Well, getting ready is being able to recognize when you don't have a valid buy signal, but the stock meets the criteria that you're kind of looking for, like in our case, part of the S&P 100 and above a rising moving average. Those are kind of the real simple criteria that we have for our two green arrows. So, I can see the stock's been going down the last few days. I see the red candles. Let me change my drawing tool to this arrow so it's a little easier to see things. I can see the stocks coming down. I can see the stocks above the rising moving average. I can see the green arrow that we had back here on the 8th of July. And I say to myself, do I have a valid buy signal based on the moving average? The answer is yes. But I need to have two green arrows. So I have a green arrow on the MACD. It was green for how long? Well, that was green for about 8 days. So it was valid buy signal for 8 days. There's a range within which we could have bought that stock, somewhere between about 130 and maybe 140. Okay. So, but we're saying that our rule, kind of based on the slides that I shared, is we're going to buy within 2 days of the MACD turning green. But here's the fun part. Okay. I look at the stock, I come home from work, and I look at Target on the right edge, and I say to myself, do I have a valid buy signal? And the MACD's red. And so my answer is no. Guess what? I'm done with my analysis. I don't have to spend any more time trying to decide what to do with Target, right? Then I come home from work the next day and I say to myself, do we have a valid two green arrow buy signal? And I say, well, we are above the moving average. The moving average is rising. That's a green arrow, but the MACD is still red. So not a buy signal. Okay, but I can hear you there. Yeah, but that's a bounce. I learned from James Boyd that red candle's the low day. That had a high there of 135.59 and it closed at 136.78. That's a bounce. You're right. It is a bounce, but it's not two green arrow buy signal. So could you have multiple different entry signals? I think you could, and I think that's fine. But if you're trading the two green arrow plan, that's not your buy signal. But yeah, but I don't want to pay 140. I'd want to buy it at 138. Okay, then revisit your buy signal. So that's why I want you to do 10 of these in a row so you can go back and analyze. Like, oh, That 2 green arrow, I got in there a little bit late. Let's see what happens tomorrow. Tomorrow, I don't even see the MACD. What's going on here? Well, if I put my cursor there, you can actually see it's a red number still. See that? Look at this number right there. So that day, in fact, if we move that up a little bit, you can see that. Okay, that's still a red. It's that brick red bar. It's still negative, negative 0.014. So it's not quite a green arrow. The stock went up again to 140, and you're yelling at Scott for not letting us buy at 136, but it's still not a valid buy signal. Next day, now we have a green arrow on target. We could buy that. If our buy signal is to place a limit order at the closing price for the next day, then we'd put an order there at 144.20, and then we would buy that the next day, right? Today is where we are now. Let's move this up a little bit here, shrink that back down. And today, the closing price, if we placed an order yesterday, that order would have filled. If we place an order today based on our rules, let's go ahead and walk through that and then we'll be done. Is the closing price today is 145.90. So we're going to put in here target. Entry price 145.90. Our stop based on our rule is we're going to put the stop 1% below the moving average, which is at 130.52. This dotted purple line is just a moving average envelope that instantly tells us where to set the stop, 130.52. All right. Now we can determine our risk per share. What's that? Well, 145.90 minus 130.52. So what is that? $15.38. All right. Maybe grab our calculator now. Let's move this up. So our calculator, if I did my math right, 145.90 minus 130.52. That's 15.38. And if I was willing to lose $50 a share, this is that position sizing rule, 50 divided by 15.38. And that I could buy 3 shares. Or the $500, right? $500 divided by 145.90. This is that allocation model. 500 divided by 145, oops, 0.9. I could do 3 shares. So both ways allow us to buy about 3 shares of this stock. So we're going to do that. Right click, buy custom with stop. We're going to go in there at 145.90. We're going to set our stop at 130.52. We'll make that stop good till canceled. No guarantee we get filled at 130.52. And we're going to buy 3 shares, lock those up, buy 3, sell 3. Let me just review the order. Buy 3, sell 3 at the stop. Again, that's going to trigger a market order. Could be filled significantly lower than that. And we're going to put it in our 2 green arrow box. And that's the order. All right. So that's, the process, and hopefully, we went through, let me go back to the slides as we wrap up today, is we covered, the definitions of position sizing allocation. We went through some of that mental dialogue, some questions, some things to consider to help you overcome that analysis paralysis. Big takeaway, no perfect entry signal. Just accept that. Some trades are going to lose money. That's okay. If what? If you base it on an acceptable loss. All right. So your homework is to figure out what that acceptable loss is. We looked at sample trade on target. There's a few others in the watch list, that S&P 100 that have what I would consider a setup. They're above a rising moving average, but the MACD is still red. So go look for those and get ready. Thanks everybody, Olga and Eva and Jay Richardson, and glad you could join us today. Have a great day, and good luck in your trading. Good luck in your investing. We'll see you, everybody.